Welcome, and let's put wealth into perspective, because in our first episode we have looked at saving as accumulations. In our second part or episode we looked at investing as creation of assets, assigning our money to different activities, opportunities and vehicles, aiming at generating positive returns. So what will wealth be? Wealth will be the accumulated assets. What is the reason for wealth? We are accumulating assets so that at a certain point in our accumulations, we will have a portfolio or a build-up of assets that generate so much incomes that we can live on. Meaning we'll be able to substitute our active incomes with the passive incomes that the wealth or assets pulled together can generate, that can sustain our living, our vacations, our philanthropy, and our legacy perhaps. Welcome back to my channel. I'm O'Brien Daku. If you are new to this channel, I request you to subscribe, engage in the comment section. We shall continue after this 3 seconds break. Thank you for your subscription, shares and comments. Let's look at a scenario whereby you have put 10,000 shillings in an aggressive investment. Aggressive investment in this case, we are looking at opportunities that guarantee a return of more than 12%. Why are we calling 12% aggressive opportunity? Because we are currently enjoying or suffering inflation rates of average of 5%. So, if you use the 72 rule of compounding, that investment will double after about 6 years. Assuming you are 30 years, it means by the time you are 36, you will have 20,000 in that investment. When you will be 42, you will have 40,000. When you will be 48, you will have 80,000. When you will be 54, you will have 160,000. When you will be 60, you have 320,000. 66, you will have 640,000. That is a perspective of compounding. And looking at the period, we have looked at 30 years to 60 years and allowing that money to compound on its own, to multiply, to double. And we are looking at, after that years, you have an amount of 640,000. Let's look at the replacement of active incomes with passive incomes. If at 60 years, 66 where we have accumulated, compounded to 640,000, and we are enjoying the same rate because of changes, assume the rate is 10% at that time. It means we are going to generate 64,000 shillings from that investment in 1 year. If you divide that 64,000 by 12, what figure you are getting is around 4,800 to 5,000. And the question is, will that amount be enough, sufficient to cover your living expenses at that time? And the obvious answer is a no. Meaning that for the longest period of time that you are investing, the amount of money that you are putting in yourself actively is more important than the element of compounding on its own. So categorically in the previous video, we emphasized the fact that we have 3 seasons in our investment or in our wealth creation phases. We have a season of saving or accumulating money, making sure that we are actively generating money and spending a percentage while maximizing the amounts that we are putting into our savings. Then the savings that have been accumulated, we now diversify and assign these savings to different opportunities, different assets. Because if you purchase shares or stocks, there are seasons where the market will crash. There are seasons where the general prices of stocks in the market will go down. A bearish market. There are seasons where the prices will go up, a bullish market. When the prices generally come down, also dividend rates come down with them. And in such scenarios, you'll be depending on the diversified portfolios that sit with bonds, the fixed income securities. So fluctuating securities, because of their behavior of change, when they are down, you rely on the fixed securities or your rental incomes, which are more or less fixed in nature. All those factors put in consideration, our wealth creation will create a pool of balanced assets that guarantee an income that replaces what we were creating actively. And therefore, at the point where you choose to switch from active incomes to passive, to start enjoying your passive incomes, you would have built enough assets that are generating sufficient cash flows that cover all your expenses, both living expenses of your lifestyle expenses, your aspirational expenses, your security expenses, and your legacy expenses. Then the question that you need to ask yourself is, the current lifestyle that you are enjoying, is it the dream lifestyle that you would want? And if the answer is yes, then multiply that by 12 to get the total income that you require in a year. Then whatever value you have gotten, that should be the amount of income that you should be generating passively from your wealth, from your collection of assets, so that you are able to continue enjoying the same lifestyle for the longest time when you choose to retire. Because retirement, unlike the general perception, retirement is a day, a year when you choose to switch off from active to passive incomes. When you choose to struggle, sacrifice, to build sufficient assets that at that time you'll be able now to switch to what you love doing. Mondays and their hangovers will no longer be the strain when you have to look for money because of the bills. But in this case, you are doing what you enjoy. Therefore, if the value that you have gotten after multiplying by 12 cannot be generated by the assets that you have so far built, it means you will still have to continue pumping money into investments so that you are able to generate enough that you can live on. And that is the reason why around us you will see a person who has retired from service and they are not able to live the same lifestyle that they were living, enjoy the same lifestyle they were enjoying when they were working. Reason being, during their active time, they never bothered about what kind of lifestyle they will be enjoying once they leave service. And it's very important. There are cases where an investment gets bad. We have a situation at the point you retire, you come to a point whereby your assets no longer generate money. You build a plot, a rental property, which has been beaten by time and outdated in fashion, such that the house is there or the rental property is there, but is unoccupied because new properties have come up with fresher amenities, and therefore you get to lose all that. All those factors have to be put into consideration, and that is where now management of your investment comes in. Wealth creation will come into two scenarios. You may have assets, but no cash flows. And at the point of switching to passive income, what is important is not the assets, it is the cash flows. The cash flows are the most important. We cannot live on assets, we live on cash flows. So the management aspect has to be part of wealth management. And in that event, it is either you are doing it or you procure the service of a property manager. You incur the service of professionals who can manage the assets. So at the active stages of your accumulation and investing, you can dedicate time to venture into the market directly. But at the point you switch off to passive incomes, you dedicate the portfolios, you assign the portfolios to professionals to continue managing those portfolios on your behalf, because at the point of wealth, once you have accumulated your wealth, other factors will come into play. It will no longer be about the aggressive interest rates. It will no longer be about the money market fund that pays the highest rate, that bond that pays the highest rate, a corporate bond. But it will be about the cash preservations, protection of that wealth. Because at the point we are able to cover what? Our expenses. So it's no longer about the aggression. It is about the trust of the fund manager. It's about the institution more than the rate. So these factors keep on changing. At the early stages where we are saving and investing, we are able to take higher risk, and that's why we go for the high paying or high return investments. But as we amass the wealth, we become a bit risk averse because we want to protect the wealth. And that is why now we look at the wealth protection measures. If you are with me at this far, you are liking the information that I'm giving. Thank you, and I would request you to subscribe to the channel, share this video to another person, engage in the comment sections, hit the like button, give me a thumbs up, because these parameters are used by the YouTube algorithm to push this kind of information to other users. And by so doing, we are educating our community. In our next video, we'll be looking at the wealth protection measure. Thank you for watching.